Hello friends, I am Rohan Sharma, your mentor in this program. Today we discuss Introduction to Commodities in India. In this lecture we have to understand how commodities is also needed to be take place in your investment portfolio. How commodities, what are the types of commodities and how you participate in the commodities market. We have to discuss in detail in this lecture. Before understanding the commodities market, we have to understand some of the facts that is well known to each of us. So these facts are: the SEBI is act as a regulator for commodities market. Priorly it is Forward Market Commission which is taking care of commodities market, but after some time the SEBI is taking care of regulators as a regulator for a commodities market. Trading on the MCX is take place from morning 9 a.m. to at night 11:30 p.m. In winters, the time is 11:55 p.m. due to satellite time changes. From Monday to Friday, the Saturday and Sunday will be off for the commodities market. 87% of the commodity trading activity take place on the MCX, Multi-Commodity Exchange, which generate an average daily turnover of 49,000 crores. There is a 3 operate national level exchanges in India. The first one and the foremost is the Multi-Commodity Exchange, considered to be MCX, the National Commodities and Derivative Exchange of India, that is called as NCDX, and the National Multi-Commodity Derivative Exchange of India, that is called as NMCE. All 3 exchanges are online and you can easily access the exchanges and transact your commodity transactions in exchanges in online modes. So these are the basic facts about the commodities markets. Now we have to understand about the commodities exchange in all over the world. Which commodity will be traded most in which exchanges? Because as we know that the commodities are global, the price is decided globally, so we have to understand that at which market opening and closing will impact the pricing in the certain commodities. So crude and the heating oil, the biggest exchange in the world is New York Mercantile Exchange, that is called as NYMEX. Soybean, soya oil and corns are mostly traded in Chicago Board of Trade, that is called as CBOT. The aluminum, copper, tin, lead, zinc or nickel, that means all metals, are majorly traded in London Metal Exchange. The options on energies, interest rate derivatives will be taken by Chicago Board of Option Exchange, that is called as CBOE. The silver, gold, crude, oil and rubber is also take part in Tokyo, that is Tokyo Commodity Exchange in Japan. Gold, silver, platinum and copper hugely trade in COMEX, that is Commodity Mercantile Exchange. Gold, silver, crude, mentha, soya oil, metals trade in India is done by Multi-Commodity Exchange. And all agri commodities like gawar seed, chana, soya bean, RM seed, pepper, jeera, turmeric, chili, sugar, the whole agri commodities will majorly trade in National Commodities Derivative Exchange of India, that is NCDEX. So by this slide you can easily understand that which commodity is trading in which particular exchange. If we categorize the commodities into their category name, then the first important category is bullions, that means the gold and silver are considered in bullions. Castor seed, soya seed, oil, castor oil, refined soya oil, all are considered in oil and oil seeds. Then in spices, we are considering pepper, red chili, turmeric, zira, cardamom, all are considered in spices. Then copper, tin, nickel, steel, zinc, aluminium, they are considered in metals. The kapas, cotton, staple cotton, they all are considered in fiber. The chana will be considered in pulses. The wheat and maize are considered in cereals. The crude, heating oil, natural gas is considered energy, and the rubber, guar seed, guar gum are considered in other categories. These all categories and the products are tradable in exchanges. There are so many benefits to trade or invest in commodities market. As an investor's point of view, the commodities market, you are getting diversification. As if the whole of the amount is putting into debt or equity, then this is a third important investment alternative that you can use. The less manipulation is taking place because it is a global market and no one is controlling the global prices in India. The third important thing is it is a high leverage product. As we know that the commodities market are tradable in derivatives, then the only you are trading in on margins, and that is create a high leverage for them. If you are an importer or an exporter, you can easily take an hedging against the price fluctuations in spot market. You can create an hedging or insurance for the spot price risk fluctuations by taking in opposite positions in commodities derivatives market. If you're a large scale consumer of a product, you can control your cost by taking an opposite position in commodities futures and ensure the continuous supply of the raw material. If you're a producer of a commodity, you can lock in the price that you produce by taking a participation in commodities market. You can assure the demand and increase the holding power by reducing the risk of inventory or reducing the risk of price fluctuations. This is a sample sheet which clearly signifies that why you diversify into commodities, and the sample table will give you the exact idea that in some point of time, if you understand the economic cycles, you can easily utilize the commodities investment alternatives for a great returns. As you show the table, sample table on your screen, in 2008, the gold will provide you the best returns of 28% in a year. At that time, the equity performance is worst in the last 10 years span in equity markets. In 2009, the gold will give you 21% return, the silver will give you 44% return, the copper will give you 120% return, the crude will give you 77% return, and the Nifty also give you 71% return. So as compared to equity markets, the commodities market is also giving you a well returns. If you compare or take the case of 2008 and 9 average returns, the Nifty will give you only 20% return or 10% average monthly return, whereas the gold will give you 28%, the silver will give you around 20-25% return, the copper will give you almost around 40% returns, and the crude will give you a negligible of 5 or 10% returns. If I average down the all returns in comparatively 8 or 10 years, then the average return is 17% in gold, 15% in silver, 14% in copper, 10% in crude, and the 6% only in equity. That means if you compare the performance of 2008 to 2013, you clearly signify that the commodity is giving you the much more returns as compared to equity. If the equity is not performing well, you have to divert your money into commodities. They are giving you a very good return in a span of time. So small understanding of economic cycle, small understanding of commodities market will give you very good returns. Sometimes you make money from equities, sometimes you make money from commodities, will optimize the overall portfolio return and give you a handsome returns. I am assure you that you will get maximum out of your investment portfolios. Where to invest in commodities? The multi-commodity exchange, the National Multi-Commodity Exchange, the NCDX, the ICE and the ACE are the exchanges where you can easily invest and participate and create your investment portfolios. All these markets are open from morning 9 to evening 11:30. In the agri commodities, the market timings are morning 9 to evening 5 o'clock. Because the regional exchanges and the local mandis are open from morning 9 to evening 5. There are various participants in the commodities market, the hedgers which want an insurance against their spot holdings, the speculators which are looking for the investment activities, and the arbitrageurs which are play on global levels and take the advantage of price inefficiencies. I hope so you enjoyed the commodities market lecture, and please assure that commodities market will give you a very handsome returns, and whenever the equity markets are not performing well, I am assure you the commodities market will be giving you the exceptional return.